morning. You know, you always tell us that you are a realist and not a bull or a bear, and you believe that maybe the market valuations don't look too good right now, especially in broader market. Is this sign of things to come in the broader market, or do you think this is just one of those phases which will get over once again? I'm talking about the mid-cap correction that we have seen all through last week and today as well.
So my guess is that today markets are driven by liquidity, but unlike in the past tops where liquidity was chasing greed, this time liquidity is coming with hope. It's more matured liquidity, and people will go into stock rotation based on performances. People will move from one stock to another stock looking at their long-term potential. So this is one phase where market will consolidate, and then hopefully it will break for the top. But this phase of consolidation can last a little bit longer.
So in this phase of consolidation, Nilesh, what would be the key markers that you would keep on the Nifty now? What could be the extent of a downside? And at what level would it be attractive for long-term investors to invest at the index level as well?
So in real sense, it is stock pickers market. The broad indices really have no meaning for portfolio managers because clearly we are investing for future, whereas indices are constructed for the past. Keeping that in mind, we believe even today, if you are a long-term investor and you are underweight in equity, this is time to build your portfolio, albeit not necessarily in a lump sum manner, but on a systematic transfer plan basis. If you are neutral weight into equity, this is the time to continue your systematic investment plan. And if you are overweight equity, it is time to book profit. So you have to focus on your goals, your objectives, and then build portfolio of stocks where you believe there is market outperformance possible.
Nilesh, you said if you're overweight equity, it's maybe time to book some profit. So are you expecting, more of a downside? What is it that's making you a little wary at current levels?
So essentially, each one has to have an asset allocation, and that is what we have advised customers. We are probably in a phase of consolidation where the long-term bullishness continues to remain intact. The long-term fundamentals of economy are falling in place. But in the near term, there could be either price correction or time correction. And which is why we are saying if you are overweight equity, take some profit out. You will probably get better opportunity to enter. But if you are underweight equity, it is still time to invest in equity. So each one according to their risk profile, each one according to their goals and objectives. But as portfolio managers, we continue to remain bullish on equity market over a longer period of time. We still believe, like in 2008, where even if you had entered in Jan 2008, but picked up stocks correctly in sectors like IT and pharma, today you still had market outperformance and positive return.
What would those sectors be now, Nilesh? If 10 years from here, you'll look back and say with hindsight, of course, that I got these right and those were the best times to buy. What sectors would you buy right now?
So Anuj, our focus has remained on the private bank space, where we still believe they will continue to grab market share from PSU banks and continue to create value for their investors. We still believe there is reasonable amount of opportunity in the rural space. The monsoons have been good, and the indirect benefit of farm loan waiver will be reflected into rural environment, rural economy, and stocks which are linked to rural and agriculture will see the benefit from that side. The third thing, obviously the big thing which is happening in near future is the GST. And clearly there will be companies which are in organized sector, which have hitherto faced unfair competition from unorganized sector, especially due to tax arbitrage. Those guys will be in a position to capture market share from unorganized sector and post better volume and better profitability. So these are some of the themes which is overarching into our portfolio. But at the end of the day, it is stock pickers market within private banks, within rural, within unorganized to organized. You'll have to go and pick up stocks appropriately.
Okay, the fall in the mid-cap space is a bit worrying now. The index is down about 0.5% and the advanced decline ratio has turned even keel. So let's get that up for you on your screen. 750 stocks advancing for nearly the same number of stocks which are in the red, and many stocks like in the PSU banks like Vijaya Bank, Allahabad Bank are selling off pretty sharply. Edelweiss Financial is under pressure. Anuj, in the morning you were talking about the correction that we've seen in the mid-cap space of late. What is happening now, and is there more to go?
It's actually good. The kind of stocks that are selling off, actually, they're all good stocks. You spoke about Edelweiss.
Apollo Tyres.
Apollo Tyres. Spoke about REC. I think Escorts over the last 3 or 4 days has corrected a lot from 750 now down to 650. Kajaria Ceramics. I think PVR, whether Tubelight did well or not, that's a different issue altogether. But a lot of these stocks, Rima, had run up a lot, and I think market gives these opportunities for those who missed out on good stocks to invest when these stocks are correcting. The short point is, do you have the conviction to buy on the way down? Because most money is made when you buy good stocks on correction, when you buy good stocks on bad days. Market's message always has been that you buy good stocks on bad days and you sell bad stocks on good days. For example, on a bad day like today, JP is up another 12%, the JP Infra is up 20%. So, these things will happen, but the profile of stocks is telling you that it's more of leverage being taken out of the market because a lot of stocks had run up, and I think it's going to make the market healthy.
What is the message that we're getting when money is being pulled out of good quality mid-cap stocks which have been outperformers?
Yeah, but see, for example, a stock like Escorts, from 120 to 800, it's down to 600. It was an 8-bagger, it still is a 6-bagger. So, the message you can take is that everything will not move in straight line, and even if you have good stock, pricing has to be right, and you have to buy at the right price. I think that's the only message that the market is giving right now.
I guess it's also taking the message that Nilesh Shah just told us. If you're overweight equities, and I guess if you are overweight these good quality stocks, which have been dream stocks, perhaps it's time to book profits then. But Nilesh, in the past, you've been bullish on auto as well as auto ancillaries. Seeing a bit of a correction now, would you top up?
Definitely, we remain bullish on auto and auto inc sector. Clearly, there is lack of public transport in India, and hence people have no option but to rely upon auto and auto inc. With lower oil prices, though not necessarily reflected into domestic prices fully, the demand for auto and auto inc henceforth will continue to remain good. Now, EPFO is also allowing people to withdraw 75% of their corpus for purchase of vehicles. That creates another demand for automobiles. The 7th pay commission will get implemented for state governments and PSUs. That also generally has benefited auto sector. So looking at short to medium term, headwinds, I think auto sector is favorably poised.
Nilesh, while we took your point on being cautious at current levels in the market, are retail investors still pouring in the money? In which case, will we see mutual funds sit on higher levels of cash in the near term?
No, mutual funds don't take cash call. Most of us continue to remain fully invested into the market, and whenever we feel that we are not in a position to manage the flows, then we do stop subscription into those funds. As of today, markets are around fair value or a little bit above fair value, depending upon whether you're optimist or pessimist. It's not that market is in a bubble. And what we have communicated to investors across the board is that why don't you come by a systematic investment plan, be a long-term investor. If there is correction in the market, that's time to put more money into equity, increasing your asset allocation towards equity, and so on and so forth. We have seen in November and December 2016, when because of demonetization markets corrected and FIIs were big sellers, we were wondering what will be the retail reaction. But the retail reaction was really encouraging. Wherever we went telling people that you should be long-term investor, they actually supported us. They gave us more money than what they used to give just a few years back. In the month of November and December, we collected more money than what we raised in just few years back. So this retail behavior is fairly matured, and I think it will continue to grow over the period of time, and that will provide stability in the domestic market. We will act as a counterbalance to FII selling if and when that happens.
Okay, by the way, Fortis really is your big selling of stock now. 166 on Fortis. It was 200, I think, on last Thursday. And from there, it's been a big slide. There was, I think, also Ashwani's 914 call. Fortis down about 4%. But, Nilesh, that's the big question, right? We have seen it happen once. Post-demon, we saw 30,000 crore of FII selling, but market moved on because it got so much domestic inflows. But at that point, we didn't have too much of a global, problem either. The global markets also moved on once Trump took over as president. Do you get a sense that if we have another correction, say, and this time probably a bigger correction, one we haven't seen, say 10-15% correction, would the retail investors stay put, add more? Is that the sense you get?
So today, Anuj, that's a $1 million question, but based on last 25 years experience in the market, I'm finding current lot of retail investors fairly matured. There was a time in 2008 when we used to go to investors and people used to ask about our credentials, how come markets are so much down and you couldn't predict it. Today, when in November and December we were meeting investors were reassuring, saying that Nilesh bhai, don't worry, this will also pass. And they actually demonstrated that by giving money. So I'm finding retail investor far more matured. They're able to differentiate corrections in market coming because of Brexit, coming because of Trump election, coming because of some events which have no relevance to Indian economy. Gone are the days that when Lehman Brothers expired, most investors in India thought that our financial system has broken down. I think that kind of reaction we are unlikely to see. Media has played a fantastic role in educating investors that something happening in UK, I mean, we don't really get impacted by that as much as we were impacted earlier. So now there is a fair amount of maturity among retail investors. Obviously, there will be few new guys who will, have to learn that by experience. But I think November, December experience has taught people a lot. I was recently in Kolkata where I met a couple of high net worth investors who took a call to get out of the market in November and December 2016. And till today, they are waiting to invest. So that experience will act as a guidance for many investors.